I hope everyone out there's had a good start to their week overall. Certainly an interesting day to kick off the last full week of 2024. Where did the year go anyway? It really did zip by. It was an eventful year. Lots of stuff happened, and I think that the year ahead is going to be another jam-packed year with all kinds of opportunities and excitement. So should be quite fun overall. And I want to thank you all for joining me for tonight's episode of Navigating the Markets. And remember that it will be recorded, and I'll post that just a little bit after we finish up here. So no presentation would be complete without our risk disclosure, of course. All trades and investments involve the risk of financial loss. So please be careful. That is really the key message here. Just be careful with what you're doing with your size, especially in a lighter holiday trading week. You just want to make sure that you're not putting on too much risk. Whatever position you're taking, just be sure you're kind of managing that risk into what is overall a lighter trading week. There's less liquidity. We do have the Fed and some other potential big economic events. I covered that all in yesterday's market prep on the Discord for Traderade members. So just be mindful of all that. So a little bit about me. I started my trading journey in 2005. I funded my own account, began trading stocks, then moved on to options, futures, commodities, and Forex as I expanded my horizons. In 2006, I began rolling my trading profits into long-term investments. I emphasize this every week because it's really important to roll those profits. You don't want to have too much risk on in your trading account, particularly the shorter time horizons of trades. You should take those profits and roll them into investments, whether it's in stocks, fixed income, businesses, real estate, or elsewhere. I did navigate through the great financial crisis, which helped me to gain a better appreciation of the importance of understanding intramarket dynamics, momentum, and macro. In fact, going on next year, it'll be 20 years of trading these markets. So I've seen a lot of very interesting stuff play out. It's given me a great appreciation for one key theme, and that is risk management. So I used to be a discretionary trader. I moved into focusing on being a systematic trader, which really means I'm trading with data as my guide. I'm taking a lot of the emotion out of it. I'm taking a lot of the individual judgment out of it and turning it much more into a systematized approach to entering trades, to managing risk, and to exiting trades, right? So I co-founded Traderade in 2022 and MacroVisor in 2023 to share my experience, ideas on market opportunities, and education. I also build a number of unique tools and models and provide one-on-one coaching for traders and investors. So let's get to our market overview. So far, like I said, this week is off to an interesting start. We had a pretty narrow breadth in the rally, which is a theme that we've seen for much of 2024 and 2023. In fact, we'll get into that a little later, but these are pretty extraordinary years overall. Today's rally was largely led by stocks like Broadcom, Tesla, Google, Amazon. These stocks that have had momentum leadership are continuing to break out, hit new 52 or all-time highs. So 52-week or all-time highs are kind of a theme here. That is to say, I've seen folks say, oh, how much higher can it get? That's not really the right question to ask. The better question is, because a lot of the time when people are asking that, they're asking it because they want to short something. And I would say, it's not a matter of like, when do I fade this? It's a matter of taking advantage of the market as exists right in front of you, right? So if you have a stock and it continues to hit new 52-week highs, new all-time highs, what stops it from continuing to do that, right? Because I see a lot of people saying, oh, this can't keep going higher and I'm just going to start shorting it because this is what I think is going to happen. Let me tell you, from about 20 years in the markets of experience, the markets don't care what you think is going to happen. They're going to do what they have to do until they're done doing it. And the reason I say that is we're small fish, we're retail. We don't move these markets. The best thing we can do is try to think of the markets as sharks and whales. And we're just these little minnows swimming behind them, trying to capture some of that momentum, put it to work in our portfolio, and make that momentum yield profits. So with that in mind, if something's continuing to hit new highs, you're better off long or flat. You don't want to short that stuff. It doesn't make any sense. You're not going to necessarily be able to repeat that strategy of trying to reverse momentum before it's happened. Like you're basically betting on a reversal before it's actually happened. That's basically trying to say, I'm smarter than the markets. No individual participant is consistently smarter than the markets. And the only thing we can really do is put probabilities on our sides. right? If we want to kind of have a strategy that continues to work, one that we can understand why it works, one that we can continue to build on and iterate, we've got to put the probabilities on our sides. That means not trading with emotion as the first decision point and trying to fade something because it keeps going higher. That's an emotional trade. That's usually I missed it, so now I want to take it the other way type of trade, right? Just avoid those. Either ride it long, go flat, look for the next opportunity, but don't try to fade that momentum leadership until it cracks, until you see a meaningful breakdown of reversal. That's when those opportunities set up. And that kind of means letting those whales and those sharks do the work. And then we come in when that opportunity is ahead of us, when the probabilities are more likely that we see a continuation of downside. So that's just a long-winded way of saying don't get into trouble out there. I see a lot of folks kind of trying to get ahead of things, trying to get cute, and generally getting hurt by some of these moves when they do that. Now we're going to zoom out. This is 1 week. We see a kind of continuation of the same theme, right? Narrow leadership. Again, Tesla, Google, Broadcom up 40% here in a week. Pretty incredible. But this is narrow leadership in the market overall. This is not an imminent sign of danger, but it is a sign of concentration risk in the upside participation. It just fattens that left tail. What that means is because risk management is first and foremost, mind your risk here, right? It's not a sign that it's time to get cute and start shorting the market in size. It's a sign to be aware that when leadership narrows, if something happens to that leadership, that presents a greater threat to that overall bull thesis, okay? Let's zoom out just a little bit more. This is a month. Again, a bit of a similar theme. Another thing you'll notice, NVIDIA down 10% over that same period of time. That's a bit of a concern. We'll get into that chart just a little bit later. But, that is a concern that I want to talk about because that is part of that narrow market leadership that we had enjoyed. Now, is the baton being handed off to others? That's quite a possibility we would be remiss not to consider. But at the same time, seeing NVIDIA roll over is something we should be paying attention to. Now let's get into some Bollinger Band squeeze breakouts. Bitcoin is one of the biggest ones. This is a weekly chart. And you can plot this on your own, and I would encourage you to create a chart like this, whether you're using stock charts, TrendSpider, TradingView, all of them have this type of an indicator. It's very easy. You're just using the Bollinger Band, but you're changing some of the parameters, okay? So it's a 50 period on a weekly chart, and then you're using a 2.1 standard deviation. So why are we doing that? We're zooming in a little bit, like we're taking in a bigger time scale, right? So we're going to take in 50 weeks worth of data, and then we're going to use that to model the way that price is moving. And that's that standard deviation. We're using 2.1 because we want just a little bit of extra confirmation. Okay, so this is a way that I like to look at Bitcoin, gold, silver, nat gas, a lot of the commodities, the softs like coffee. And the reason that I like to look at it through this lens is it's just pure price volatility and momentum. So you can see Bitcoin, for example, it really does value the 50-week moving average. We could see that over the late summer, that it was testing that average, holding there. But what really got this to be an interesting chart was this expansion. So you had the squeeze and then a breakout. The squeeze breakout is one of the most powerful volatility triggers on a Bollinger Band squeeze type of move. It tends to lead to a pretty significant extension. And for something that's purely driven by momentum and psychology like Bitcoin or gold, this tends to be one of the more reliable strategies to look at to see when is it time to enter, how can I capitalize, for example, this breakout to the upside. That's a very powerful long signal. And you can actually zoom in and see this signal fired off even earlier on the daily chart. Because Bitcoin is so volatile, you could also have taken this signal on the daily, or really the original signal firing off was in February of this year. Right? That was when we started to see this expansion and the climb above the top Bollinger Band. And I don't consider the signal invalidated unless we close below the 50-week on a weekly. So you can see this was a Bollinger Band squeeze. Then you had a little bit of a consolidation. You had that breakout here, this consolidation, and then a continuation higher. Now, why does it matter? Because this is a indicator that a lot of people use in a sort of inverse way than what I would recommend. So a lot of people look at the Bollinger Bands as resistance, right? And I get that because it's a standard deviation, and in a market that's in consolidation, they work as resistance. But when a market's in motion, you don't want to use a Bollinger Band as resistance because often is the case, it won't work that way. It'll actually work against you. So in a Bollinger Band squeeze breakout, when these Bollinger Bands are expanding and you're seeing price run up into them and then above them, if you're using it as resistance here, you were getting killed. You punched above, you get back down. If you were shorting at that, you'd say, oh boy, look, I hit that resistance. And then it just punches right back above, right? So it's not resistance. It's about tracking momentum. This is why I have the band width chart below, because you can see the bands expanding down there, showing you there's this expansion, that squeeze, and then break out that leads to that larger upper price move, right? So the whole idea of the squeeze is you have this period of consolidation, the market's at rest, bandwidth is very narrow, right? And then you have this expansion, and the expansion's happening with a continuation of price, in this case higher. And that tells you there's this greater increase of volatility and there's a huge momentum change happening. In this case, it was this big continuation higher with much greater volatility. So that's just in a nutshell how to use a Bollinger Band squeeze breakout on a number of different asset classes, and it works on the daily and the weekly depending on your own time frame as a trader. So something to take into consideration. And it foreshadows this next chart for coffee. Look what we have happening. We have this squeeze period, right? Then we have this modest expansion. Now the expansion is gaining velocity. So this is a big Bollinger Band squeeze breakout. And you can see if you were trying to use that top band as resistance, you were getting killed, because it would keep punching above it and blowing shorts out. Because when a market's in motion, the band should not really be considered resistance. Now, when it's consolidating, like it is here with this low period of bandwidth, right? Very low bandwidth. That was resistance. That was support. That worked until you get to that expansion period. At that point, it becomes a better way of gauging momentum. So that's the nuance for Bollinger Bands. Their support and resistance and consolidation, they're a way to gauge momentum when the market is in motion. The next chart I have for you is crude oil, and it's starting to look like we may be putting in a bottom here. Now, I do think crude is going to be a choppy trade for many months to come. We're going into 2025 potentially with a bit of a glut of supply. We're still not really seeing China stimulate in size, although they continue to promise, and maybe at some point they'll fulfill those promises. But for now, we are at least seeing some degree of positive momentum. We can see that in the MACD histogram on the bottom. We can see this break above the 21-day EMA and then the 50-day SMA here. Test, break above today with that push just about 2% higher. I do think crude can make a bit of a push higher here. I would be looking up to about 72.50 as the next pivot. If we push up above there, I think we may start to see some excitement up to about 74, basically getting back to these areas of price interaction with the market, and potentially this sort of gappy area to fill in. But at the end of the day, crude is still likely to be a choppy trade going into next year without that big China stimulus. So we're really looking for China to come out and do something to stimulate their domestic economy, to kind of ring fence in the real estate risk, get consumers going back in and spending more at retail. We got retail sales data recently from China that was pretty disappointing. The slowest growth in quite a long time that we continue to see in that market, I should say. So it's just overall, and we'll talk a bunch more about China. I've got some great information about their economy and markets to share. But overall, we're really looking for that government to come in size and stimulate. And if they can, that's where I think we get the opportunity for oil to really run. If they don't, then we're probably stuck in a range between the low 60s and the low 70s for some time. The next one I have here is NVDA, and oh boy, it does look a bit ugly out there. We have this death cross We have a bit of what looks like a head and shoulders pattern, and we have confirmation building, momentum fading. It does look like this stock wants to move lower. So I am cautious because this is market leadership. This is one of the stocks that not only became one of the biggest companies in the world in this growth spurt that it has experienced, but it's also started to see some signs of getting just a little long in the tooth. For example, during their most recent earnings call, we heard from management that margins are compressing. They're narrowing to the low 70s. They hope to get them back to the mid 70s. They had been as high as the mid 80s. So that's a bit of a change, right? We also see the European Union and China starting to scrutinize NVIDIA for antitrust. We saw a little bit of whispers of that from the US regulators as well, but I'm really more focused on other countries because I don't think regulation is going to be a strong suit of the next administration here. But nevertheless, Europe and China could exert some influence over NVIDIA. So there are some risks building in this stock, and there is competition here, right? AMD, Broadcom, Qualcomm, Intel, and others actually have compelling offerings. The crux of the issue is they can't offer that on the CUDA ecology, which is exclusive to NVIDIA's hardware for now. If that ends up changing because of some kind of regulatory crackdown overseas, then you could see NVIDIA's margins further compress, their sales slow more, and other companies really get a leg up. Now, for AI and for tech, that would be good, right? Less sort of toll booths on the information superhighway on the path towards innovation it's a good thing. But that is going to be something that can only come about if there's more of that sort of effort to open up CUDA to other hardware players, in my opinion. For now, though, I think NVIDIA is starting to confirm this head and shoulders pattern. I do believe that's a risk-off type of signal. We've got the death cross, the firm rejection at the 50-day, the MACD histogram rolling over. All that has me looking at an initial downside target of 116.29 and lower areas of potential support at 102.80 and 90.57 should the stock continue to roll lower. The next one I have on my screen, and this is so funny because NVIDIA is a big part of SMH. So the relative strength of the other components in semiconductors is definitely getting my attention here. And SMH has a look like it's bottoming. Look at that push. First, yesterday, or Friday's trading, I should say, we had that clean bounce off the 21 EMA, and we were able to close above the 50. Today, we retested the 50 SMA, and we built volume above it, closing 1.51% higher. I dare say we may have seen a near-term bottom in the semiconductors here, and this is with NVIDIA rolling over. So that's kind of a powerful signal. It's something to keep an eye on. Obviously, Broadcom playing a role, Marvel playing a role, some of the other semis kind of basically rallying in the wake of NVIDIA's weakness. And if that continues and SMH is able to run with that sort of relative strength is something to keep an eye on. That would be a very healthy sign. Another one that's been running, Taiwan Semi, is looking strong. You're seeing a lot of positive call flows in that. So just something to keep in the back of your mind that even though NVIDIA looks kind of weak here and there's reasons for it to potentially weaken, that's not a death knell for all the semis. And in fact, NVIDIA kind of sucked all the life out of the party. For the latest run in NVIDIA, the rest of the semis were basically flat. I mean, you can see they didn't do a lot over the last several months. Now, maybe we're starting to see some signs that they want to break out as NVIDIA is weakening. So will be interesting to see if that rally broadens. Next chart I have for you is DBA. We've been long this one for a while. I think it's time to trim a bit. So I would want to take off my core 2/3 of the position. This has been a great winner. It's up, over 10% since we really started talking about getting long in early September. And we talked about adding to that position and some of the weakness. Now that it's had this really good run and we're getting into the end of the year and we've had, some signs that some crops may have better than expected yields, I think overall it's time to take some profits off. I also think the coffee rally is getting a little overextended. So wouldn't be surprised to see that at least consolidate, if not correct. And that's been one of the contributors to the upside here. But overall, a great trade in a part of the market where a lot of people were kind of not looking because it's not as exciting as tech, right? Admittedly, it's not as high beta. It doesn't make the same kind of moves, but that doesn't mean you can't make some good trades from these lower beta indices and ETFs. Another one I like here that I've been talking about bidding is ITA. And we can see this is a weekly chart and it's just pinging the 21-week EMA. I think this is a time to nibble, to start, if you don't have a long, to start considering one. And if you do, to add to it. That would be my thought with this chart. You can see it tends to respect that 21-week EMA. That 21-week EMA is something that in this uptrend overall, it's respected. It's also an easy way to manage risk. If we close the week below it, obviously it's time to no longer be in the trade. But for now, I think that we're going to probably see a bit of consolidation and then building higher in this one. And then looking at volatility, it has slumped since the election. There's a little bit of a bid back up today. We do have VIX expiration this week and options expiration this week as well. So I think vol is looking just a little bit cheap. I know call skew on the VIX is pretty high, but I think that overall, just a number of the different volatility measures, whether it's move, VIX, oil vol, gold vol, they all seem a little bit low. So in particular, hedging out portfolio risk by looking at long VIX or looking at SPX puts 3 to 6 months out at the money, so VIX calls or SPX puts 3 to 6 months out at the money or just out of the money seems like a decent hedge if one's not raising cash and wants to have an insurance product. This isn't a bet by any stretch of the imagination. It's more about just hedging out long exposure and not getting caught flat-footed if we do see a risk-off moment. Now, let's talk about the options market. Positioning is centered at 6,000, 60, 50, and 6,100. So last week, I talked about on Sunday night that it's likely we'd be sort of pinned in this range. And unless and until we broke out of it, things are going to be kind of boring in the S&P. That doesn't mean it'll be boring in the entire market. There's all kinds of action happening underneath the surface, as we saw on the heat map. But in the S&P itself, we need to either break decisively above 6,100 or below 6,000 to really get this thing moving again. And based on all the dynamics of this week, unless the Fed does something that's really surprising, either surprising in a good way, like more dovish than expected, or in a bad way, more hawkish than expected, then I don't know that we're going to break out of that range this week. I think it's more likely, given options positioning and the stickiness of this range, that without a big catalyst, we're probably not going to see this range broken until next week, post options expiration, post triple witching. Another thing to take into consideration is skew is well off its highs. So we are still in a well-hedged market. We are also still in a market that is seeing some signs, not universal signs of euphoria, but some growing across multiple different measures. So that's something to take into consideration. This elevated skew is likely to add to some of those Van and Charm flows that help to bid the market in the first and last hours of trading, particularly this week. And then those flows take a break after Thursday, really. So something to take into consideration in your trading. If you're day trading this, just be careful trying to fade that first and last hour because these flows are still likely to be a bit elevated with what we're seeing. Now let's go into the big picture here. Hedge funds are really long this market. Gross leverage is approaching all-time highs again, and net leverage has been on the rise for months now. So they're adding to positions. They're not necessarily longing tech. They're more into these old economy stocks. In fact, recently they've been shifting up some positioning, and we'll get into that in a little bit. But nevertheless, what I think is very interesting about this is you have this big FOMO into the end of the year, this sort of window dressing. Oh gosh, we missed a lot of this rally, because you can see they weren't that long for a while. I mean, we're nowhere near even now where we were at the peak of 2021 before things rolled over into 2022. We're now just starting to get back to levels we saw in early 2022. Right? So it's really interesting how long it's taken for hedge funds to kind of get their confidence back in this market, just at a time where we saw long-only funds really piling in all year long. So the hedge funds kind of late to the party, often producing substandard returns, unfortunately, for their clients, even though they're charging 2 and 20 or 2% fee plus 20% of profits, which is a little bit extravagant in a world where you can get passive exposure at 10, 15 bips. Anyhow, risk on sentiment by this measure is the highest since 2018. This is an indicator that is a combination of positioning and sentiment, and it gives us a sense that people are really, really bullish of this market. Now, I would say that's just a little bit of a concern. It feeds into that left tail risk. It's not an immediate timing signal. It's not an immediate risk off signal. If anything, the opposite. There's probably some continuation to something like this. But it is at least something to keep on our periphery to say, okay, but if a lot of these folks saw a bigger down move, they'd be motivated sellers. So I just need to be aware of that risk should it happen. Looking at this in the form of flows, because it's not just sentiment and positioning, there are flows going on underneath the surface. November saw the largest inflows into the equity markets ever. We also see single stock put call skew suggesting a 9 out of 10 in positioning. That is a very extreme measure. That is telling you that people are extraordinarily bullish of single stocks here. So a lot of that risk being hedged out in the broader indice, in the S&P put products. As we can see, put skew is pretty blown out over there off of its highs, but still quite elevated. But there's a lot of single stock long positioning. And this is in the really popular stocks that are being traded right now. Tesla, MicroStrategy, Apple, Google, Meta, etc. Now, another area of risk, particularly for these regional banks, office commercial mortgage-backed securities. The loans are spiking. Now, I remember some folks saying even as early as 2022 that it was going to be all commercial, real estate was in this huge debacle and we're all going to die. And, I always found that a little curious because it couldn't really qualify that anywhere outside of offices. But offices have structural problems, chronically high levels of vacancy, work from home being more of a trend, outsourcing, becoming more of a trend, less and less utilization of office space overall, even hybrid work, where you have people sharing the same desk, working 2 to 3 days a week, all that becoming bigger trends. And businesses also compelled to save money. A lot of small and medium-sized businesses simply can't afford to have rent and keep on the same number of employees. So they made the decision to downsize offices. And in some cases, they just stopped paying rent where they couldn't pay rent. And that's what this delinquency rate is showing us, that more and more folks that have these commercial mortgages are also not paying them down, which is basically a sign that the people who own the office aren't getting paid rent in such a timely manner that they can afford to pay their mortgage, right? So those mortgages, who's the counterparty? It's the banks. It's mostly regional banks that lend to these. This could be an issue for them if we don't see the long end of the yield curve start to come down. If in fact it starts to go the other way and push higher, that could put more pressure on their assets. So one part of the market I favor avoiding: regional banks. Doesn't mean I want to avoid, JP Morgan or some of the other larger banks out there, but the regionals I just have no interest in. Another area that's interesting to look at: Americans are holding record shares of their assets in equities. This is another sign. Part of it's from the appreciation of value, obviously, but there's also, again, this sort of latent FOMO. A lot of people are rushing to buy. We saw it with that November record inflows. So that's just a little bit of a sign of caution. You start to wonder how much more money do they have that they want to deploy that can't just be, part of their short-term liquidity to meet budgetary requirements, et cetera. How much more money is left to deploy in the market versus how much could come out if you see a motivated downward move. So again, not a risk-off signal, just a tail signal. The tail is fat a bit on the left side. Speaking of fat tails, this is a sign of a relatively narrow market. Just 31% of stocks in the S&P 500 are outperforming the index in 2024. It's a bit higher than 2023, which I think was, I want to say it was 29%. And 2023 was the lowest participation since 1999. And then before that, 1998. So it is something to be concerned about. Just, that there's this narrow leadership, so concentrated risk in a handful of stocks. One of those leaders is rolling over, and that's NVIDIA. Ahead of PCE this week, we are looking back at CPI, parsing the tea leaves for clues as to what all we may see. And one theme has remained consistent. Shelter is the largest contributor to upside CPI, particularly at the core, but it makes about a third of CPI. This is something that, we heard a lot in 2023 and even early 2024 that this would roll over, but housing prices have not. In fact, in some areas, they continue to move higher. There's also that latency between when owner's equivalent rent sort of factors in those rising prices, there's about a 6 to 8 month delay. So we're still seeing that pass through, and that's still leading to stickier inflation readings with risks to the upside as we get into 2025. One of the slides that Aisha shared with the MacroVisor 2025 Global Outlook, which you can find on our Twitter, on our website at macrovisor.com, and on the MacroVisor YouTube, is the risk of stagflation. So this is something to take into consideration as we get into 2025. It's not all bad news. It just means the where you want to put your money may change to some of these older economy stocks, industries, and sectors. Okay, so something to think about. I would recommend watching the 2025 MacroVisor Global Outlook for more. Another area that is interesting and is helping to keep interest rates higher, particularly on the long end, is the interest expense is expected to skyrocket to a quarter of taxable income. That's a pretty big deal. And that would be some of the highest levels that we've seen in decades. So that tends to put some upward pressure on interest rates. It tends to put pressure on the budget as well. There's less money available for other initiatives if rates remain high. It's also one key reason why the Federal Reserve is most likely to consider interest rate cuts in an environment where stocks, home prices, crypto, and other things are making new all-time highs. Now, Morgan Stanley shared this slide. I also posted it out on Twitter about the policy impact of what we may see in 2025 and beyond from the Trump administration. And the net conclusion here is really, if we see bigger disruptions to DC, that could be problematic for equities and credit. But if it is more of a sort of status quo type of scenario, then we may see just a modest bull market. And if we have a sort of fast announcement, slow implementation type of scenario, that also may limit things a little bit. So it's overall, steady as she goes. We do know Wall Street loves gridlock in DC. And given that there's a very narrow majority of Republicans going into this administration, gridlock is something we may realistically see, particularly in some of those initiatives that need more than just a simple 51% majority. Now, speaking of Trump trades, some of the flows that we've seen so far since the week of the presidential election have been into areas like crypto, bank loans, money markets, leveraged funds, U.S. small caps. Those have been the leaders, with selling of emerging market debt, Europe, Japan, treasuries, and China. We'll see if those trends continue, but there's certainly ones to keep an eye on. Shifting over to the global picture, the trade-weighted U.S. dollar nears historical record highs. This could put some pressure on emerging markets in particular, but international markets as a whole. It is good for exporters, but when you talk about how much debt is denominated in dollars, the combination between rates and the dollar rising tends to put some pressure on that debt, tends to put some pressure on those equities as well, especially if you have unhedged exposure, because then you have direct currency risk in your returns as well. And this week, we've got a lot of central bank decisions happening all over the world. So something to take into consideration. It isn't just FedNest Day, although that is clearly the most important day for global markets. Other central banks are also going to be weighing in with their policy decisions, including the Bank of England and the Bank of Japan this week. And one area shifting over to emerging markets that I'm actually quite optimistic about is Malaysia. ETF EWM. Malaysia is investing aggressively in their domestic chip making capabilities, and they're actually one of the most aggressive of anyone in the world. Year over year, they're the most aggressive, just not by total spend. That would be China, and then we could look at Taiwan and some of these others. But Malaysia is becoming a premier destination for reshoring. I do think we're going to see a lot of this sort of AI chip and peripheral semiconductor development, memory fabrics, flash, NAND, etc., happening in Malaysia as well. They've been a partner of Seagate and Western Digital and Micron and other companies for quite a while. I do think that's going to grow over time. We're going to see more part making and full fabrication happening in Malaysia. So bullish on EWM going into 2025 is one of those longer term ideas, one of the emerging markets that could benefit from a lot of things that are going on. Now, moving over to China, China is struggling. China's retail sales rebound was pretty short-lived. Retail sales slow, really just not seeing what you want. You don't want to see this rolling over when the government keeps talking about and ostensibly telling us they're doing stimulus, and yet we're not seeing that. In the domestic picture, things still look really weak. Now, on the export side of things, it's a completely different scenario, right? China's trade surplus is at a record high. It's nearing $1 trillion at $957 billion. That's a big deal. That's also one of the reasons that Trump has his eyes on China. He wants to narrow that trade surplus with the United States as much as he can. And I think that's going to be a big part of those trade wars that are sort of taking effect as soon as he gets into office, and we start to see those negotiation tactics and what comes from them and which segments of China's exports are targeted. Meanwhile, however, over the last 20 years, China has become the largest global producer of cars, going from just 1% to 39%. If you add the US, Japan, and Europe together, China is in excess of all three combined. Incredible. And China's financial conditions are the easiest since June of 2020, which has sparked an enormous inflow into Chinese equities, the biggest inflow in 9 weeks. So there are animal spirits forming around China, but in my view, it's all about whether the rubber meets the road. Does the government actually get out there and stimulate in size, targeting their ailing real estate market, which has been on the precipice of collapse for years, and domestic consumption trends, which, as we can see, are lackluster at best. So with that, I want to take a break and go to questions and answers. If you have any questions for me, let me know. So seeing a question here from Johnny Dankseed, my buddy, and he's asking, did I see the most recent Netflix upgrade? Do you think it's a bit high? This coming over Benzinga. Netflix just got a huge upgrade. Analyst Jason Helfstein raised his price target from $8.25 to $10.65, and here's why. And he's talking about the NFL. He's talking about some of the other initiatives that Netflix is engaging in. And then there's less competition as well, with Paramount and Comcast seeing high churn rates. So I would say that Netflix, one thing they're doing really well is they're executing with some degree of shrewdness. Like they're, didn't get the kind of growth in video games that they wanted to. So they kind of backed away from that initiative. And, this is something we talked about for the last several years, that it's such a hard area to break into. So I was glad to see them back out. Personally, I canceled my subscription because I wasn't super happy with the variety of content, but I can see why it's a compelling value proposition for people that are subscribers and how they're able to grow into multiple global markets. Like they're making content for specific regions in the language, filmed with actors from the regions, kind of like building stories that cater to the culture and so forth. So in that sense, they're doing a lot of things that are really smart, and then they're getting into live streaming. And so it's hard to say whether it's too high with the way animal spirits are very, very intense in the markets. But I will say that I feel like a lot of these stories are starting to get a little bit more thin. They've been going, largely driven by pulling forward future returns into the present. And so that does concern me a little bit with this. Like if they don't execute perfectly, there's a lot of risk with how much of a move the stock has had. Yeah, that's a good point. The Tyson fight had a ton of technical issues. So, our larger scale sporting events going to go better. And what does that say about Netflix's engineering prowess and their ability to scale their content distribution network when it's under pressure? And, I would hope that they've already resolved that stuff. But if they haven't, they really need to, because that's make or break for live events. It's totally different than streaming stuff. Live events has a much more sensitive infrastructure to latency, to jitter, to bottlenecks that you're not necessarily going to have if you're streaming pre-existing content that you can distribute to nodes all around the world in advance. Yeah, great question. It's a very interesting time. Again, like just maximum bullishness. So it's hard to fade this stuff. But on the other side of it, it's like, okay, but at what point have we kind of said, maybe we're getting a little ahead of ourselves? And I think we're closer to that point, but I don't know if we're quite there yet. I think it may be a Q1 2025 story, that sort of handing off the baton from tech to old economy stocks, if I'm right about that thesis. Yes, a lot of the low quality company flow is getting a little bit weird. So something to look at as well. Tis the season to be squeezing. You got a lot of hedge funds that are very short single stocks here. So you've got to be on the lookout for those types of moves, and also the folks that are trying to take advantage and rug the people that are trying to take advantage of those type of moves. It's sort of like a couple different memes I could think of there. But all right, so I think that's it for questions here. Appreciate everyone tuning in. Hope you all have an awesome rest of your day. And stay tuned. We've got a lot in the works at Traderade with our growing partnerships with some of the leading platforms out there like TrendSpider and Bookmap, but also with what we're doing in-house. So I hope you all have a great rest of your night, and we'll catch up tomorrow. I'll be here 9 a.m. Eastern to talk about how I use Bookmap to analyze order flow in futures and stocks. So join me then.